We're going to be talking a little bit this afternoon about, or this morning rather, about financial instruments, IFRS 9. Not the impairment side, but the rest of it. Now, we started to touch on some of these issues yesterday when we started to talk about things like the SPP&I test and the interaction of IFRS 15 with IFRS 9. Based on what happened yesterday, based on the discussion we had, I haven't got too many slides. I'm just going to be picking a few slides out of the pack so we can actually stop and discuss again in detail, like we did yesterday, the specific mechanics and where the issues come from. In the packs you've got in front of you, you've got a lot of slides. And the idea is the lot of slides give you the ability to take something back and hopefully have a little bit of reference data when you get home from the discussion that we've had. So just bouncing straight into the presentation. For those of you who don't know, this is very high level. Essentially what we've got is IFRS 9 is a composite package that replaces the three legs that existed in IAS 39. So the three legs in IAS 39 were classification and measurement, impairment and hedging. IFRS 9 replaces almost all of that. The one thing IFRS 9 does not replace at this stage is what is called under 39 portfolio hedging, what is called in our new development process macro hedging. Now that, for those of you here who are supervising banks, is a very important distinction. It means that post the adoption of IFRS 9, your banks will almost certainly be continuing to use at least an element of IAS 39, the portfolio hedging element. Because for banks, portfolio hedging is one of the primary things they do. It's an ongoing activity that banks have. So you will see that there'll be a little bit of a mixture of IFRS 9 and IAS 39 in bank accounting. Michael mentioned earlier that somebody had asked the question, what happens when you transition from IAS 39 to IFRS 9? Is it a change in accounting policy, etc.? How do you treat it? Essentially, when you transition from one standard to another, the new standard has very specific transition requirements. You don't use the IAS 8 process, you don't use anything else, you go directly to the transition requirements contained in the new standard. And essentially, and I think somebody asked me this question yesterday, when I am transitioning to IFRS 9, the transition requirements are very specific. And what they say is it is a fully retrospective approach. In other words, on the first day I adopt IFRS 9, I will state my accounts as though I had always applied IFRS 9. So I'll restate my opening balances. But IFRS 9 gives a lot of relief about restating your prior period numbers. So it simply says restate on the day that you convert, but you don't have to go back and restate your income statement and restate your balance sheet and etc. We do that for two reasons. In part because it's very hard to go back and restate history. But even more importantly, the restatement of history requires, when you're dealing with a standard like IFRS 9, that you apply hindsight. It's almost impossible to stand here and look back a year, knowing everything that has happened in the last year, and say, let me imagine myself back 1 year and let me pretend I know nothing has happened. It's an almost impossible thing to do. So for that reason, it's much easier for us to say you start on this date and you apply it prospectively from this date. You don't have to restate your comparatives. Does that make sense, everybody? Cool. Okay, so that's the first part of it. Also, anybody in your current jurisdictions who has not yet started to adopt IFRS 9 will only now be able to adopt IFRS 9 in totality. For a while, you could adopt IFRS 9 in stages. That ability is now gone. It's disappeared. There's no longer the ability to do that. The other thing, I guess, that's important for most of you operating in, I guess, for almost all of you, EU areas, the endorsement process of IFRS 9, which is the process by which the Commission adopts and endorses a standard, has reached a point where, as of a couple of weeks ago, the FRAG and the ANC Commission advised the Commission to adopt, sorry, not ANC, ARC, advised the Commission to endorse IFRS 9, subject to the fact, and we'll get to this discussion later, subject to the fact that they consider excluding insurers from that endorsement process. And we'll get to that in a few minutes to talk a little bit about what that's actually going to mean. So right now it looks like endorsement is going ahead. It looks like endorsement is likely to happen. I suspect there may be some pressure on the European Commission to consider allowing entities an extra year to adopt, given how long endorsement has taken. But we'll hear where that gets to eventually. We haven't heard anything in that space yet so far. You.
Adoption will be not on the 1st of January 2018.
Right now, what's essentially happening is the recommendation from EFRAG and from ARC to the Commission is that adoption goes ahead of the standard as written by the IASB. So they've recommended endorsement as written by the IASB. The problem for me is just looking at this, their process has taken a long time. And so I wonder if they're not going to receive a few letters at some point. Whether they will stand up to those letters or not is a whole different issue. But I suspect at least there will be a few letters in the post. Okay, so the next point here is it will, let's go straight on, I think. It's available from 1 January 2018 as things stand at the moment. As I mentioned, maybe the endorsement process comes up with a different date. The important thing for many of you from a regulatory perspective is you may find even if endorsement recommends a different date. So let's say EU endorsement is 1 January 2019. There may still be pressure on banks in your jurisdiction to go with 2018. And that's because although they are reporting, obviously within the context of the European Union, they are also reporting outside very often for banks outside of the European Union. And they find it quite difficult on occasion to deal with these sorts of delays or these different timings when they come along. All right. So I'm going to look at the model, and as I say, I think this is where the opportunity comes to sort of raise questions as we go through the individual elements of the model. So what I'd suggest we do is we're going to work with one slide, but we actually spend as much time as we need on that single slide. So what we're dealing with, financial assets, classification and measurement. What we talk about in IFRS 9, which is very similar to IAS 39, is I need to classify an asset, I need to determine, I need to put a label on an asset, I need to put a tag on an asset for a better term. That's what we term classification. And then based on that tag, I determine what the measurement methodology is going to be for that particular asset. So when I start thinking about it, when I start thinking about classification, the first question I have to test is the cash flow characteristics of the asset I'm looking at. What are cash flow characteristics? Well, this is the thing that we were talking about yesterday when we talked about the prepayment penalties. The cash flow characteristics of an asset are the cash flows that are contractually built into that particular asset. So I'm testing the asset itself. And what am I looking for? I'm looking to see whether the cash flows in that asset are principal and interest only. What is principal? Principal is the amount I have lent to the individual. What is interest? Interest is the reward that I expect as a lender, the amount I'm prepared to pay as a borrower, to compensate for time value of money, for credit risk, and for other risks inherent in the actual contract itself. Okay. So what I'm doing here is I'm simply testing the product to see whether it is solely principal and interest. Almost every lending arrangement that you have is likely to qualify as almost every is likely to qualify as solely principal and interest. The vast majority of lending that happens out there requires that the individual on the other side pays back the principal and pays a time value of money reward. Okay. We go on to say in the standard that if there are elements like the prepayment that you mentioned yesterday, but they are inconsequential, they're not significant in the overall number, they're a very small number, don't worry about them. But as soon as they become a significant part, and what you described to me sounds like a pretty significant part, I have failed the test. And I've had a look just for interest at things like BMW finance, Mercedes finance, etc. And almost all of them have significant penalties for early payment. So I think they're going to have to look at those contracts and consider whether or not the contracts they have fail this test. Any questions on SPPI? Foreign exchange loss can happen in two ways. The one way, if foreign exchange loans is not an issue. Because essentially what you're looking at a foreign exchange loan. So I lend you money in Swiss francs. Okay. The Swiss franc loan between you and me will be based on you repaying it to me in Swiss francs at an interest rate that is relevant to the Swiss franc loan. So I've paid you the amount, you will repay me something in the same. Now what we may have done is we may have agreed that we will lend the money in Swiss francs, but the actual cash flows will occur in a different currency. But that's simply a conversion thing. At the end of the day, what am I getting in a foreign exchange loan? I'm getting the equivalent of the Swiss francs at the date of loan. I'm paying an interest that is relevant or that is appropriate for Swiss francs. And at the end, I am paying back the euro equivalent of the Swiss franc principal that I owe. So essentially, there's nothing odd about that. What would be different? Caps and floors. I was going to say, what would be different is I've now inserted caps and floors into it. So if I say you have to pay me back in Swiss francs as long as it's not more than X, you have to pay me back in Swiss francs as long as it's not less than X. Now suddenly I have a contract that I can't really say is just principal and interest. Because under certain circumstances, it's no longer principal and interest. Under certain circumstances, I'm paying back something that is different to the principal amount of the loan. Yes?
And I just want to clarify, in the yesterday's discussion, your point of view was that considering the fact that this prepayment penalty is inseparable from the loan contract itself and no additional services provided, it should be included in the interest. But from this discussion, why can then somebody fail this test if it is not included in the, if it is included in the interest?
What I said yesterday, and it's good that you've asked me the question so I can clarify. What I said yesterday is that the penalty that you pay is not a service. You haven't performed a service. Therefore, you are not in IFRS 15. IFRS 15 deals with services. Therefore, you are entirely in financial instruments. So under financial instruments, I now need to decide, what is that penalty payment? Is it normal interest? Is it interest in the normal course of business? Or is it some other feature in the contract that is not principal and is not interest? Now I'll ask the question about that specific amount you're talking about, that penalty. Is that penalty a reward for the time value of money? No, it's not, because actually I'm having to pay the penalty even though I no longer have access to the underlying funds. And so that suggests to me it's certainly a financial instrument, it's certainly part of this instrument. But the instrument you're talking about has three components to it: principal, interest, penalty. If the penalty is more than insignificant, then the instrument fails this test. Likewise, if your instrument, the caps and floors, sound to me like a significant part of the contract. The caps and floors are not purely interest and principal. So I suspect your instrument, and potentially, depending on the size of the penalty, your instrument, both fail the test. Now, the one exception for your instrument will be, are you buying out the difference between the interest rate that you're paying and the current interest rate? So is it simply a purchase out of the process? Or is it a fixed penalty? If I pay early, it's a fixed penalty. Then it seems to me that it's not interest and it's something else. So this is tough. This is one of those things that's requiring entities to have a really good look at the instruments they've got.
What's the relevance? It's up to banks management to define whether it is relevant or irrelevant, the level of penalty or...
So the terminology we use, and I think it's something like inconsequential or less than insignificant. So it's a very, very small test. Okay, it is left to judgment, so you look at the instrument, you look at the nature of the instrument, and you decide based on that whether the number is an insignificant number. If it's insignificant, that's fine. Okay, you don't look at it. So it is a judgment call from management. We've given a couple of examples in the standard to help people understand what it means, but I think there are a lot of instruments out there that will fail this test. Yes, sir. it doesn't matter because essentially what, and maybe let me go, or let me talk to why this is important. So the reason why we think this test is really important is an instrument that is purely principal and interest. A good accounting reflection of that instrument, okay, is amortized cost. Because what I'm seeing, and this sort of goes back to the discussion you had earlier with Michael, amortized cost is an appropriate representation of an instrument that is just principal and interest. Why is it an appropriate representation? Because essentially, what is an instrument that is just principal and interest? I'm going to receive regular payments back. I'm going to receive a regular interest amount every period. They're not unpredictable. They're entirely in line with my expectations. They don't change from period to period. And they reflect the nature of lending money. As soon as I introduce a cap and a floor, my numbers that I'm going to receive have become completely unpredictable. I can't measure them using an amortized cost because I don't know what the actual flow is going to be. As soon as I have a significant penalty, my number has become unpredictable. I don't know what I'm going to actually receive back. That unpredictability of the number means that amortized cost doesn't become an appropriate measure. I need to measure something more than that. Just to finish answering your question. So then the second part I'd say then is even if the caps and the floors are out of the money on day one, that doesn't mean they're going to stay out of the money for the whole period. They may well become significantly in the money at some point through the process.
Do you see here some problem for us as regulators? If these basically loans don't pass the SPPI test, then we don't have this tools, probability of default, loss given default. It's not typical loan stuff and things that we have in our balance sheets.
That's a very good point. So essentially what's going to happen is, now let's look at what happens. If I fail the test, okay, I go to fair value profit and loss. If I go to fair value profit and loss, it means I'm accounting for something at fair value. Now I'm hoping Michael did a really good job this morning of telling you fair value is much better than amortized cost. Succeed. Okay. So what you're going to do is you're going to end up with a situation where you're right. You may well end up with some basic instruments you consider as vanilla instruments that are now being measured at fair value profit and loss. Okay. And because they measured at fair value profit and loss, I don't get my impairment information. And within the context of what the way IFRS 9 has been written, there was a lot of requests, a lot of concerns about this. So there have been some reliefs built in for your vanilla type products. And those reliefs will help get some of the products at least, so if it's not too significant a number, et cetera, will help get some of those products into amortized cost. I think you stand a chance. My personal belief is you've got no chance. Okay? And it's because a penalty is generally a standard type of thing in a lot of products, and it's just whether the penalty is ridiculous. Whereas a floor and cap, or cap and floor, is very much a derivative type of a process. It can have a very significant effect on the outcome. It's an unusual characteristic of the contract. You are probably going to find yourself in fair value profit and loss. Okay. Yes, sir.
Just to clarify one more thing. In this respect, whether or not the penalty will be included in interest, there is no difference between IFRS 9 and IAS 39, yes? So if the penalty is a part of interest, it would be a part of interest under both standards, as I understand. And this is the first question, and also I want to ask such a thing. If this penalty is too high, would it be possible under IAS 39 to somehow split the penalty and include part into the interest and the other part as a commission income or something like that?
Certainly, if I take your product, what would happen under IAS 39 at the moment is the product over there has got essentially an embedded derivative. Under IAS 39, what you would do, and it's easier to talk about that product because yours is kind of gray area, yours is very clear. Under 39, what you would do is what we call bifurcate. Bifurcate suggests you break up the product into two pieces. The embedded derivative, which is essentially the cap and the floor on the amount that you're going to pay, okay, and the underlying or the host contract. The host contract you measure at amortized cost, the embedded derivative you measure at fair value. IFRS 9 does not allow bifurcation. It says you cannot cut an instrument into two pieces. You either all one way or all the other way. And the argument behind that, the reason for that, is that any cutting of an instrument into two pieces is essentially an artificial structure. You're doing something that is artificial, that doesn't represent the reality of the instrument. So under IFRS 9, you would simply treat this as a single instrument. You would look to the SPP&I test, and if you fail the SPP&I test, you are in fair value profit and loss. End of story. Yes, sir? You're worried about the instrument?
We are worrying about, I don't know if you are acquainted with it, but there is a mortgage credit directive that will be in place in the European Union since 21st of March next year. And for countries which have foreign denominated mortgage loans, they will have to give by law options to customers to convert their loans into or foreign currency or sell them some sort of an option to hedge them against the foreign exchange risk. So in looking at which solution should the banks offer regarding the best treatment in IFRS 9, would, for example, an option to convert to domestic currency in the next, in certain at certain foreign exchange level, be past the SPPI test? Is it different than an option because then you will return principal and interest just in another currency? Would this be a loan or?
It's a fair question, and to answer your question, no, I wasn't actually familiar, or I'm not familiar with the directive, but it's one that I'll take note of to have a look at when I get back. On the face of it, my argument would be it makes sense then for banks to make sure they sell the products as two separate components. So I sell the mortgage, and then over and above that, the customer is given the ability to buy a product that allows them as a separate product to buy or sell the, or to exchange in or out of the currency. Because I think then you've got the ability to say, you've still got a derivative. There's no question in my mind there's a derivative. That ability to swap is a derivative instrument. Okay. Unless you're saying it's always exercisable, which obviously, I mean, it's compulsory exercisable, but I assume it's not compulsory exercisable, it's a pure choice. It's certainly one then, as from my perspective, I'll definitely take this away and have a look at it, because I think this is something that potentially means that every foreign currency mortgage issued in the EU, applying this derivative, this directive, is a fair value profit and loss mortgage. And I think that just based on what you've said, what you've got is you've got a single instrument that is a lending instrument and has embedded derivatives, and they're compulsory embedded derivatives. They're part of the single instrument. They give an option to the user of the instrument. I suspect you're in trouble there. What I'll do then is perhaps respond. I'll have a look at this, have a look at the directive over the next day or two, see if there's something in the directive I'm not conscious of right now. But at the starting point, that's where I think you are. If there's something that I'm not, I'll send it to Pascal to send out to everybody here, just so that you sort of got our general view on it. But thank you for the information. And the idea, the logic behind it is exactly the logic we've discussed. The problem with an option like that is that option has a continuous value. You are granting the borrower an ability to do something, which is an ability to avoid the volatility inherent in the currency mix. Okay? That ability to avoid that is a real option, which has real value, and that value is not determinable through amortized cost. I'm not going to understand that value through amortized cost. The only way I can understand that is by revaluing that option on an ongoing basis. Now, in part, what might happen, because I can't think why a bank would want to do this product anymore. It seems to me like essentially what a bank is going to be doing with this kind of product is they're giving the borrower a free option to exercise against the bank at any point in time when it is in the borrower's favor. It seems to me you'd be crazy as a bank to be issuing those products, but let's put that aside for the moment. So you may find there are less of these products around. But certainly fair value in that sense, I think, is giving me real information about the nature of the product, and I would suggest all of these products are going to be at fair value. The main reason I raised this topic is we were speaking yesterday about the importance of looking at impairment, the importance of making sure you've considered impairment and the issues around impairment, and et cetera, et cetera. Here's another issue that your bank should be looking at as soon as possible. Because they can't fix this. If their product fails their test, the product fails the test, and they need to account for it that way. And that means they need to have in place the ability to report it on this basis. They need to be able to determine fair value and present fair value on the balance sheet with sufficient certainty, with sufficient auditability and verifiability. So they need systems here. Alternatively, they need to stop issuing these types of products. Plan B. But it's something that they need to be considering. So that might be the other way to do it. The other way to do it might be to sell a mortgage, separately sell the hedge, but the two need to be disconnected. In other words, I need to be able to say, okay, I've paid for the hedge, but in 3 weeks' time, actually, I don't want to pay for it anymore, so I'm going to stop the hedge. They need to be separate instruments. And I think my problem with the way this directive is written from what you've said is I'm not sure that's possible. I think the way this is written, both contracts are issued as what we'd say in IFRS in a broader IFRS term, both instruments are issued in contemplation of each other. I can't issue one without issuing the other. I can't issue the second one without having the first one. And in that case, essentially, they are a single contract, even if I put them down on two pieces of paper. So I think this is an important issue, and I think it is one that we need to have a look at and just make sure there's not something I'm missing, and maybe the directive is written in a cleverer language than I've thought. But I think this might give rise to concern. Okay, so first issue we need to follow up on. All right, if I pass the test, so we said if I fail the test, I go into fair value profit and loss. End of story, nothing else happens, I'm straight in there, and that's what I need to deal with. If I pass the test, in other words, my contract is just SPP&I, then under IFRS 9 I've got a second test. And the second test is a test we call the business model test. How do I manage the assets? So the first one, asset-specific test. The second one, how do I manage the contract? Actually, before I go on, I just want to go back for a second to the SPP&I test. Does it make sense to everybody that a derivative instrument in itself fails that test? So a derivative instrument can't just be interest and principal, can it? What about an equity instrument? A share. It also fails the test, doesn't it? Because you don't have just principal and interest. You have all sorts of other things happening. So essentially, the only things that can pass that test are vanilla lending type instruments. So your normal mortgages, your normal credit cards, your normal personal loans, your normal corporate loans, they'll all pass the test. But equities fail, derivatives fail, and very odd instruments fail. Another important point here that comes from our discussion on Monday. Monday we talked about resolution processes, and we talked about bail-in instruments. What is a bail-in instrument? A bail-in instrument is an instrument that at a point in time at the decision of the regulator can convert from a normal loan into equity. The regulator will simply decide these 5 instruments now are subject to bail-in, you get X number of shares in lieu of the amount you put in. Just principal and interest? Something else happening, isn't there? The value of the bail-in feature is not a constant value. It changes with the value of the underlying bank. Okay. So essentially, if I'm holding somebody's bail-in instruments, I would probably fail this test. So this test is going to be really important. And we've spoken a lot about banks and how it affects banks, but this test affects insurance companies just as much. Because insurance companies also hold these instruments. Insurance companies often would look at bail-in instruments as a desirable type of instrument. So they'll often potentially hold those types of instruments. Okay, so that's what happens if I fail the test. If I pass the test, as I said earlier, I've now got to consider the business model. Now, there are three types of business models we consider. The first business model is a business model where my intention with the, well, no, I've got to use very careful with that word. Intention is not the right word. My past practice has revealed that my practice with those types of portfolios, with that type of business, the way I conduct business in that specific area, is that my business process is both to hold the instrument and to sell the instrument. Okay, so I've got a dual process here. Sometimes I hold the instrument, sometimes I sell the instrument. I don't always sell it, but equally I don't always hold it. Classic example of this, banks' liquidity portfolios. Liquidity portfolio of a bank very often has both of those objectives, the objective to hold and the objective to sell. If you qualify for this business model, if this is your business model, then you are in fair value OCI. If I think about insurance companies, I think for insurance companies, they are always in this business model. You very seldom find that an insurance company has only the intention to sell. You very seldom find that it has only the intention to hold. It will have a mixed strategy. In terms of normal corporates, how important is this test? I think a lot less important, because you'll be looking at the underlying, because you've got a lot less business activities that fit into the space. In all likelihood, ordinary corporates are going to, more often than not, be able to determine what their process is very simply. So they will look at the underlying purpose. If the underlying objective is investment, we take the Microsofts and those companies that have very big portfolios of liquid assets. It is investment, but very often they're doing both buying and selling and holding for the duration. So I think a lot of corporates would be fair value OCI. I think that's where they end up. All right, so you end up with a fair value OCI approach. What is fair value OCI? It probably gives you the kind of answer you might be looking for in terms of loss given default and all of that, because essentially under a fair value approach, under IFRS 9, what I do is my income statement is completely and utterly amortized cost accounting. My profit and loss is on an amortized cost basis exactly the same way I'd normally do it. But my balance sheet is carried at fair value. And the difference between those two things, the difference between the profit and loss number at amortized cost and the balance sheet at fair value goes to OCI. So I don't affect performance, but what I do affect is I constantly carry the fair value on the balance sheet. Logic behind that? Well, if you think about it in the context of a bank's liquidity portfolios, the buying and selling activities that happen in a bank's liquidity portfolio are generally are generally to prove the liquidity, to lengthen maturities, etc., etc. Okay. What you want to see with that portfolio, you want to know what the fair value is of a liquidity portfolio, because if a bank is forced to sell the underlying assets, they will sell those underlying assets at fair value. So fair value is useful information on the balance sheet to tell you about the future. Changes in fair value are not necessarily useful information, because essentially what's happening in those liquidity portfolios is you are requiring the banks to hold those counters. Very often they'll hold the counters until the end of duration. They're simply collecting the cash flows. The fact that they are obliged to hold them means that the fair value as a performance measure is not necessarily as relevant. But fair value as an indicator of future cash flows might be very relevant. And so the fair value OCI seems to provide a sort of a useful balancing act between the two. And as I say, to the point that you've got there, you then actually, from a regulator perspective, getting both fair value and amortized cost information for this category. The next business model test is a business model test we call hold to collect. What are you doing in hold to collect? Essentially in hold to collect, I am putting financial instruments on my balance sheet, and my intention is to hold them through the life of the transaction. I'll have them there all the way through. Those instruments will stay on my balance sheet until they mature. If that's the circumstance, so now I'm taking together the two items here. I'm saying that their cash flows are purely interest and principals, and my intention is to hold them through their life until they expire. Taking those two things together, I've essentially got a situation in which amortized cost provides me with information that is indicative of the future cash flows I expect to receive on this instrument. Amortized cost is telling me about the nature and the amount of the future cash flows, and so we argue in that circumstance, amortized cost is a useful measure for these instruments. Make sense, everybody? Okay.
For some cases, I guess I mentioned yesterday, it's not very straightforward to analyze the business model. For example, the portfolio, the standard gives some guidance on the classification. For example, how the portfolio is managed, that the remuneration, whether it is based on fair value, whether the portfolio is analyzed on fair value basis, etc. And when you analyze these points, you might come to the outcome when about 50% it's fair value supports fair value OCI classification, and the rest supports fair value through P&L classification. So what would be your recommendation when doing such an analysis, or your view on this?
So let me answer that in two ways. I think the first thing is that we haven't defined what the size of a portfolio is. So just the way you've described it, I'd be semi-inclined to think that there might actually be two portfolios there. One portfolio where I'm clearly managing it on a fair value profit and loss basis because I'm constantly buying and selling, and I manage it on a fair value basis, and etc. And a second portfolio where I'm actually managing it differently. If these two things are clearly managed as a single pot of assets, in other words, it's one portfolio, my assumption would be that it's a fair value profit and loss. In other words, I think you always step up in this equation. If there's doubt, you move up one level. And the reason behind that is that if I have a mixture of assets and liabilities in a specific pot, okay, and I'm managing that pot as a single pot, and some of those assets I'm going to sell on a regular basis and some I'm not, but I am managing it as a single pot, that suggests that any one of those assets might be the one I choose to sell on a regular basis. And so I think you probably start moving towards fair value profit and loss. The other side of it might be, though, is that if I've got this pool of assets here, and within this pool of assets, what I essentially say is I will definitely hold a lot of it until maturity, but I will sell off the top for various reasons. I want to change maturity. This is a regular thing that happens in insurance. I want to change the duration of the underlying contracts, etc., etc. Then to my mind, there is clearly a hold to maturity objective. There is clearly a sell objective, and I'm in the middle. I think one of the problems we had before this middle category came along is the one you're talking about, which is where I sold some, I held some. Which of the two, the very top or the very bottom, was I in? In a situation where I think you're talking about, where I'm clearly selling some and holding some, and that is my intention, I think I'm probably in the middle category. So sorry, I think I might have contradicted myself in walking around in a circle there. But I think in essence what you're saying is if I'm actually trading, it doesn't matter that some get left behind and not traded, that's fair value profit and loss. If my strategy, my objective with a particular portfolio is to deliberately hold some until maturity and to deliberately use others to trade in. And an example I'd say here is I might have a mixture in a particular portfolio of corporate bonds and government bonds. The government bonds are more liquid, it's easier to determine, the market is much easier to access. So I'm holding this portfolio with a single clear objective. The objective is to collect cash over time, but from time to trade in and out of that portfolio. But because of the extra liquidity of the government bonds, those are the ones I usually trade. And because of the lesser liquidity of the corporate bonds, those are the ones I usually don't trade. Do I have to split the portfolio into two? I don't think so. I think that I've got a single objective. I'm measuring the whole pot in a single way. And the fact that I have an intention to trade more in one than the other is irrelevant to the overall objective that I'm looking at. It's judgment. Yes, sir.
Just maybe it's the continuation of this discussion. So, as I understand, standard does not indicate any sequence in which this test should be made. I want just to make clear my question. There may be two ways to perform tests. Maybe you have a portfolio where you cannot identify whether it is the first one, hold to collect and sell, or the second one, just to collect. You may choose the one way. You can, for example, perform the first test, and if you clearly do not see that the both collect and sell criteria are classified, then just put these exposures in the second bucket. On the other way, you may make the different way. So just test first that if you just need to only collect the cash flows, put them in the second bucket, and rest put all rest exposures in the first bucket. There might be slight differences, so the standard does not preclude any sequence, yes?
That's absolutely correct. Definitely it doesn't preclude any sequencing. I'm not clear in my own mind you get a different answer, though, if you change the sequencing. I think at the end of the day, the SPP&I test is an absolute test. If you fail the SPP&I test, you're in fair value, profit and loss, no matter what your business model is. On the other hand, if I start with the business model, and I put something into the business model according to this, and then it fails the SPP&I test, the business model is irrelevant. I then look to the SPP&I test. But so I can't, and maybe you want to go through it again, I can't see a circumstance whereby coming at it from the other side, so business model test first, then SPP&I, I'd get a different answer.
From analyzing whether the portfolio is holding and sell, or whether it is amortized cost, or the fair value through P&L is a residual. Like, how you start the analysis.
Absolutely. And I think in terms of starting the analysis, which way you start it, as I say, we don't dictate that. So essentially, you can decide what is easier for you to start the business model test, see what falls out in the business model test, and then apply the cash flow characteristics as an override. I think that's equally valid. But I don't think you'd ever get a different answer, depending on the order, because you're still going to say that everything that fails the SPP&I test, even if its business model is hold to collect, like the instruments you're talking about, where the business model might be hold to collect, but because it fails SPP&I, it goes to fair value, profit and loss anyway. And I think probably the process here, the easier one, is to say, well, if I know that most of my instruments that fail this test are also traded instruments, then I might start the other way around, because then I actually don't need to do, because for all the instruments that are already in fair value, profit and loss, essentially I don't have to do the business model test. I don't have to do the cash flow characteristics test, because there's no effect of doing it. So I think there is a process issue, and I think you can actually attach it from either side. But I'd be kind of concerned, and maybe we don't need to go into that detail now, but we can talk about it over lunch. I'd be kind of concerned if there is a subcategory of instruments that you think the answer would be different depending on which angle you come at it from. But I think the answer should be exactly the same no matter which way you come at it. And it's more about how easy it is for you to get the information in different places. The advantage for me about doing it this way is I do an instrument level test, and then I don't even have to think about business model if it's failed that test, because it's straight to fair value. Business model goes out the window. But the other way to do it would be I do the business model test, and then I don't have to think about the SPP&I test if it is in the residual for the business model. So one or the other either one I think can work. Generally happy with that process though. Okay, so those are the tests. I think we've got something to follow up in terms of the directive. That is important. All right, over and above that, we also have options in this. So you've gone through an SPP&I test, you've gone through a business model test, you still have an option to account for something at fair value. So even though you might have decided it shouldn't be accounted at fair value, either based on the combination of SPPI and business model. You can still put it into fair value if and only if doing so eliminates accounting mismatch. When is there an accounting mismatch? Well, in this circumstance for an asset, an accounting mismatch comes about if my liability is measured at fair value and my combination of SPPI and business model says I'm measuring the asset at amortized cost or at fair value OCI. Then I'm allowed to correct it by taking a fair value option. This is a big deal for insurance companies. So insurance companies very often measure their liabilities at a current value. They want to measure their asset at a current value. Sometimes their assets might not get there through the other tests, so they may well use the fair value option to get there. Okay, the scope only for accounting mismatches, so it's a narrower scope than 39. 39 allowed you to do fair value options on a far more frequent basis, and it's irrevocable. Once you make the election, you can't unwind it. Once done, it's done, and it lives forever. You can't actually change it. The other option we have is you've got an option to choose to take equities through OCI. So remember what we said, equities fail the SPP&I test. So automatically they at fair value profit and loss. I have an option to undo that, and I can actually carry equities as fair value through OCI instead. They must not be equities that I hold for trading. So if I've got a trading desk, they wouldn't qualify for this. And again, you have two restrictions. The first restriction is that it's irrevocable. Once you've made the decision, you're stuck with the decision. The second, and maybe just as important, is that you're not allowed to recycle. So you've put what you've done with the equities, you've carried the equities at fair value on your balance sheet. The changes in the value of the equities are carried through OCI. If you then sell that share at some point in the future and realize that unrealized profit or realize that unrealized loss, you never take the unrealized profit or the unrealized loss that is now realized back to income statement, to profit and loss. It's not recycled. Okay. That makes this a very unpopular option because a lot of people who wanted to take changes in the value of equities through OCI wanted to do it because they didn't want to carry the year-on-year volatility of the changes in the equity, but they did want to take the profit when they sold the instrument. Okay. And essentially we've said, no, we think that if the profit taking is important to you, then actually you should put it in fair value profit and loss. Why? Because equities are liquid instruments. You can sell them at any stage. So every time you choose not to sell, there is information in the change in fair value. The sales, the fact that you're selling it is simply something you could have done at any point in time. So we think it's important. So primarily what this will be used for, we think, primarily the intention, is if you have very long-term shareholdings in another company. And an example would be very often the motor manufacturers will take shares in the underlying companies that supply their parts, for example. So they'll take a 5% shareholding. Toyota might take a 5% shareholding in the guys that make its airbags. It's a strategic holding. It's there for 25 years. They do it because they want to cement the relationship, not because they're trying to cement a fair value accretion. Fair value is therefore, changes in fair value are therefore irrelevant in the income statement, and fair profit and loss on profit or sale, on sale of the underlying instrument is also irrelevant for the purposes of the strategic relationship. This has a big effect on insurers as well, because insurers hold a lot of equity positions, and the volatility of those equity positions will be reflected in their income statement. Argument from the board side is we think that is a valid representation of the changes in value of the underlying investment portfolios of insurers. Yes?
Thank you. If I understood you correctly, these could be shares in pension plans as well, like pension funds? And if yes, the second question is, could those be impaired later on, as now they can be?
So you answer that question two ways. The first question is no, they can't be impaired. In fact, one of the reasons why we went the route of no recycling is that we can't figure out a way to determine an impairment of a share. The price has either gone up or the price has gone down. If the price has gone down, does it mean it's impaired? Not necessarily. Hey, so currently, it was the difficulty with IAS 39 is that the impairment test for shares didn't make an awful lot of sense. It caused a heck of a lot of heat because people didn't really understand what that test was meant to mean. And when the board considered this and we thought about an impairment test for shares at OCI, we said, well, the same problem holds. When is a share impaired? You don't really know when a share is impaired. There's no real... So the argument there was that we won't go down the impairment route. You are getting the fair value on the balance sheet. You're getting information in OCI which tells you about the changes in the value of the share. But there's no profit or loss event that actually happens other than cash flows from things like dividends. Okay. So that's the argument with equities. In terms of pensions, I think you've got two different situations. If you have housed the pension in a separate fund, so it's put into a fund and the fund has both the assets and the liabilities, there's very specific pension accounting that comes into play. Okay, but the assets in that circumstance will be fair value, profit and loss, and what you're accounting for is the difference between your obligation and your asset, that net difference. And that net difference is allowed to go through OCI. Okay. If you have purely the liability on balance sheet, okay, and you don't have matched assets, you've simply bought some assets that happen to be on your balance sheet, then you account for those assets in the normal course, so you wouldn't get this relief. But in the fund sort of situation you're talking about, I would measure the assets at fair value, I'd measure the liability according to IAS 19, and then there's relief provided in the way you account for the difference between the assets and liabilities, but also no recycling. So you also don't recycle that difference back once you realize it. Okay, any other questions? You don't ever recognize gains, you don't ever recognize losses. They are recognized only in OCI. So you'll see them in OCI, they're very apparent in OCI, but you never recognize them in profit or loss. No. So let's take a step back. Essentially what happens with equities is equities are always fair value, profit and loss, if I follow the normal test. That means I always show the gains and losses. This thing allows me to exercise an option, an irrevocable option once with an equity, to decide whether that equity should follow the always test or whether I put it into OCI. If I put it into OCI, it's always in OCI. So there's two different measurement models for equities: fair value, profit and loss, fair value, OCI. And there's an option to get you into that second one. Correct. Because you don't need, for the first one there, I don't need a fair value option because for equities, I'm automatically in fair value. Okay, so I'm always there. I don't need an option to get there because I'm always there already. Okay. Any other questions? All right, so that was financial assets. Now let's talk about financial liabilities. Other side of the balance sheet. With the financial liabilities test, we start the test on the other side. The first question we ask ourselves is, are the financial liabilities held for trading? In other words, do I trade in these financial liabilities? If the answer there is yes, then it's fair value, profit and loss. So I take it straight to fair value, profit and loss. All other financial liabilities, so the ones that are not held for trading, are at amortized cost. Okay, so it's a very easy test when it comes to financial liabilities, unless I choose to exercise an option. And again, the point would be here, the option is only available to me to choose if doing so reduces or eliminates an accounting mismatch. So this is simply the opposite situation of the one we talked about earlier. In this situation, I've got assets that are at fair value, profit and loss. My conclusion applying this test is my liability is at amortized cost. I need to get rid of that mismatch. I have an option to get rid of the mismatch. The mismatch, again, this option is the same as the previous one. It's irrevocable. It can only be exercised at inception, etc., etc. Once I'm in, it's in, and then I carry that liability at fair value through profit and loss. And I see Michael's still here, so I can ask him directly. Did you talk about own credit this morning?
Yes, we did.
Okay, so you've had the whole, you understand the whole thing of own credit, you've got the background on own credit. What IFRS 9 says at the moment is, if I have a situation where I am carrying a financial liability at fair value profit and loss, and I'm carrying it at fair value profit and loss because I've exercised the option, then we think it is correct to continue to reflect that liability at fair value profit and loss. So you will reflect the full fair value of that item, okay, including any effect that arises from your own credit. Because as Michael would have illustrated to you earlier, if I actually sell that, if I early settle it, if I do something, I have the ability to realize that future profit or loss. So I continue to carry it at fair value. However, what I do is that the difference between the fair value of the the difference between the fair value of the instrument based on normal market stuff and the fair value of the instrument based on my own credit. In other words, the impact of my own credit on the entity goes to OCI. I don't take it to profit and loss. And that is really to address the fact that there is a counterintuitive effect of own credit. Own credit is without question and appropriately represented in the fair value of the liability. That's real. But it doesn't act or feel like performance for the entity. It feels like something different to performance. So rather than take it through profit and loss, we take it directly to OCI. And similar to equities that we spoke about earlier, once it goes to OCI, it stays in OCI. It doesn't come out of OCI. It lives there permanently. Okay. We don't recycle it even if we actually eventually sell the instrument, or we eventually, buy back the instrument. So even if we realize it. Obviously, what will happen in the normal course of business, if I don't buy back the instrument, what happens is essentially a pull to par effect. The own credit effect gets smaller and smaller each period, and it essentially recycles through simply self-reversing as you pull to par over the life of the transaction. But if you do choose to early settle that liability, or if you choose to buy back that liability, then you won't see the effect ever come through profit and loss. The idea there being, while we accept, as I say, that fair value makes sense, we are uncomfortable with the idea, or we share some of the discomfort that people have about whether own credit, changes in own credit, ever represent management's performance for the entity. And there are a couple of different arguments for this, and I think, Michael, I haven't actually seen your presentation this morning, but I guess a part of the presentation is talking about why you get this effect. What is the cause of the anomalous effect? Okay. And the cause of the anomalous effect is simply then that because you are you don't have a current valuation for goodwill, which moves in the opposite direction when something bad happens, you get what's a one-sided transaction. You're only seeing one side of the effect. And so this is how we change it, by taking that one-sided transaction and putting it in OCI. The information's there, but it's not reflected in the same place, was not reflected in profit and loss.
Maybe it's still a question. In Georgia, we don't have any such case of under IAS 39 exercising the option of fair value. But could you bring an example? For example, what could work as the indication of own credit risk deterioration in the context of emerging markets where we don't have, for example, not all banks are rated, and the information is not so available as in other advanced countries.
I think essentially what you would probably be doing in that circumstance is you'd be taking as your indicator of the market some sort of risk-free indicator like a government bond or something like that. That gives you a clear indication of what changes are due to the changes in the market. Now, you might do it with the government, you might do it with other banks in the industry. A difference between other banks and my particular bank is then specific to my particular bank. And that suggests anything that's specific to my particular bank is essentially my own credit, because that's the only thing that can be specific to my bank. So essentially what you're doing is you're testing the changes in value against a benchmark. And if you don't have a particular benchmark, you can look for other benchmarks. I would think that the starting point would be you'd look at the interbank market, because the interbank market is essentially looking at all of the banks in that market. It's taking out potentially, it's averaging out the effect of any particular bank's change in credit, and then compare your bank against that particular market. Anything that then changes is likely to be own credit. Do your banks have this problem, though? Do they have liabilities at fair value under the fair value option? So then it's not even relevant to your banks, I think. So it's an issue that, I mean, we saw this issue significantly over the last 5 years with a bank like RBS. So RBS, when 2008 hit, made huge profits here. And then in 2010, in 11 and 12, when it started to fix up its things, made huge losses. And it was that counter effect. But it was because it had chosen to carry a lot of liabilities at fair value. And if you haven't chosen that, then this doesn't become a problem. Okay. All right, the last topic I want to cover very quickly is hedge accounting. I'm going to say very quickly, there are an awful lot of slides in your pack that cover hedge accounting, so I don't think it's something that we need to, so the information is there for you to take away. But the reason why I wanted to just touch on it quickly, or the reason why I don't think we should spend too much time on it, is the reason I started on earlier. My suspicion is that most banks, most insurers, will not use hedge accounting under IFRS 9. IFRS 9 gives you an option. It says for portfolio hedging, where you're hedging big portfolios of instruments, you have to continue using IAS 39 because there is no IFRS 9 solution. For individual hedging structures, okay, you've got a choice of either using IAS 39 or using IFRS 9. The reason why we've had to give a choice in this space is the scope of the two different sets under IFRS 9 and IAS 39 is different. So there's an overlap. So you may well find that if you applied IFRS 9 general hedging, some of the things you used to do under IAS 39 would not be allowed anymore. Okay? But there's no replacement for those things yet under IFRS 9. So we've just given a simple choice. The reason why I think banks won't exercise this choice is banks usually hedge on a portfolio basis. The reason why I think insurance companies won't use this choice is insurance companies usually hedge on a portfolio basis. So for both of them, IAS 39 is going to give a better answer. For those of you that are capital market regulators, I think this does become important, and it's going to become important for two reasons. The IFRS 9 approach to hedge accounting is still based on the idea that I have one hedged item and one hedging instrument. But what IFRS 9 does is it takes away all of the rules that IAS 39 had. IAS 39 had a whole lot of rules. You can only use this type of instrument, you can only use it under that sort of circumstances. You have to look at whether or not it's effective, but effectiveness testing is based on 80% to 125%, so bright line effectiveness testing. There were an awful lot of rules. As a consequence of those rules, a lot of corporates, a lot of companies that were not financial institutions said, this is just too complicated. I really don't want to do this. Doesn't make sense for me. I know in the bank that I worked in, the single biggest group of chartered accountants we had working anywhere in the bank, this was their job under IAS 39 to comply with the rules. There was a group of 20-odd chartered accountants that worked in one department whose sole job was to try and justify accounting hedging. Right. IFRS 9 takes that all away. What IFRS 9 hedge accounting says is if your risk management policy is in place and you are following a risk management or risk mitigation process, then you account for it under the process that's set out in hedge accounting. What does account for it mean? It means that the derivative instrument that I use for hedging is already carried at fair value because it failed that SPP&I test we spoke about. So that's already carried at fair value. Under the hedge accounting approach, I identify the thing that I am hedging, be it interest rate risk, be it oil price, be it whatever, currency risk, etc. And that thing that I am hedging is also measured at fair value. So I get consistent measurement on both sides of the balance sheet for the period of time that my hedge is active. I can't stop hedging unless one of two things happens. I've sold the hedging instrument or I've sold the hedging item. So I can only stop if my transaction actually ends. But once, during the period of the hedge accounting, I'm accounting for both pieces exactly the same. Who's going to be affected here? I think any companies with significant risks like foreign currency risks, like commodity price risks, interest rate risks, etc., etc. And I think this will be picked up in a much broader way by the corporate worlds, even though I think financial institutions may not may not do this. I think the other corporates are likely to pick it up because it is vastly simpler than what they did previously. And the important point here is you'll see some convert their IAS 39 into IFRS 9, but you might also see some that never practiced hedge accounting before start to practice hedge accounting because of the simplicity. Okay, essentially what's going to happen, so under IFRS 9, under IAS 39, there were a whole bunch of complex rules about non-effectiveness. Okay, you had to decide whether you were non-effective and etc. Under IFRS 9, what I'm essentially doing is I'm fair valuing the derivative, and I get a value in my income statement. I'm fair valuing the thing I'm hedging, and I get a value in my income statement. If I have an ineffective hedge, those two fair values are going to be different. And that difference is now in my income statement. So it's dealt with in the income statement simply by the process. And I think that's what makes, in some ways, this a nice approach, is because it's a simpler approach to understand. And it's also why we're then comfortable to take away any rules. So the only thing we say here is you need to establish that there is an economic relationship between the hedging instrument and the hedged item. I can't hedge the share price of Anglo Gold with diamond prices. But I can hedge it with anything that is correlated to the two, and all I have to prove is that there is some sort of positive correlation. And then the ineffectiveness, I essentially wear the ineffectiveness. It comes straight through the income statement and it's there. Any other questions on this? So I think the biggest effect of hedge accounting is likely to be on the capital market guys, as opposed to the banks and the insurance companies. The one thing I have seen that has an effect on banks particularly is this means that banks have become more aggressive selling hedge products, because they actually sell the hedge product and they sell the risk management strategy, so that you've actually got the ability to sort of tick the box with your auditors. Okay. Wanted to just cover a couple of the challenges, because I think these are going to be really important from the perspective of regulators in terms of making sure that the banks and insurance companies and capital companies, other companies that you work with in the regulatory environment have started to think about this. Now, hopefully we've touched on a lot of these points already, so I don't think there's anything that's likely to be too new. The first thing is the PP&I test. It's really going to take a lot of thought process. It's going to take a bit of work. The difficulty with this one is we've got a principle which says solely PP&I, and then we've tried to soften that principle by allowing certain regular products in. Now, one of the former colleagues of Mike and myself used to have something that he wrote on the board in his office, and it said, you can never soften a principle, you can only undermine a principle. And I think this is the difficulty in this space. So what we've done is we had a very simple principle. It's only principal and interest, nothing else gets in. And then we softened the principle because we were worried about the kind of things that you guys are worried about. Okay, you stay worried, but you might be off the hook. Okay, we were worried about the things you were worried about, and so we softened the principle. By softening the principle, we've made it a little bit harder to understand, a little bit harder to work with. So I would be talking to banks and saying, this is your, in classification and measurement, SPP&I test is your number one thing to look at. So I think that's really important. The business model test, as we've talked about up until now, the business model test is essentially a judgmental test. It's looking at the way I do things, it's looking at the way my business is operated, it's looking at the way I measure and reward management. It has got crossover points that are going to be judgmental. So looking at that early is also makes a lot of sense, because it does have an effect on the accounting down the line. And then I think the third point there are spaces that we've spoken about, a number of places in classification where you get to exercise discretion. Okay. The earlier a bank understands how it's going to use that discretion, an insurance company, a non-financial institution, the earlier they can start to evaluate what the outcome is going to be. And then I think the last bullet point on this slide is really important, and at the risk of making Mike dance at the back of the room, I suspect for many banks there may be more fair value accounting than there was previously. It's not a rule, The bank that I used to work at, they've actually determined, based on this, that they're going to do less fair value accounting. And that was because essentially what that bank did, or what we did in those days, was we took the entire investment bank, the entire merchant bank, and we simply made every asset and liability fair value option. We simply put all the assets and liabilities at fair value, and we were very comfortable to measure them at fair value. Under this approach, that doesn't exist. There is no blanket fair value option. There's only the matching principle. And so they have concluded, based on the initial analysis, that they will have less fair value than they previously had. But I suspect for many other banks, it's going to be more fair value. And to your point, that suggests that there might be information you're not going to be getting. And that suggests you might want to start thinking about either, firstly, understanding where that's going to happen, and secondly, understanding how you're going to compensate for that potential loss of information. Now, the one little rider that goes with that is in determining the fair value of something like a mortgage instrument. A very big part of that determination is loss given default and probability of default and et cetera, et cetera. In other words, I'm looking at the credit characteristics of an instrument in order to determine its fair value.
You are in fact going to mess a little bit around our traditional banking book and trading book. You will not. You will have some classical loans in the fair value or fair value measurement that was usually in the banking book. So this supervisory view at the banking balance sheet based on the banking book and trading book will be a little bit messed up. I don't know what other regulatory maybe.
Yes, I think that's spot on. So essentially what you're saying is that you're going to now need to consider the fact that within what you label the banking book may well be some assets that are actually carried at fair value, which is not the traditional approach to banking book assets. That means from a regulator perspective, you're going to have to consider one of two things. I think the starting point would be to say, yippee, I'm getting better information in my banking book now than I got before, because these are complex instruments. I get a better understanding of how those complexities interact. So that's one approach. The other approach may be to require the entities that are submitting returns to you to also provide an adjustment to get you back to amortized cost. I think Michael just ran out the room screaming. But it may be from the perspective of getting a consistent approach to the whole of the banking book. That may be one way that you want to think about it. My inclination would be to say you're getting better information under the fair value approach. You just need to consider how you're going to treat that better information in your regulatory approach. But I wouldn't seek to undo the fair value approach. But comes back to the point, I think it is a valid consideration for you as regulators to think about.